Welcome everyone, my name is Duncan Hodnett and I'm Head of Global Distribution at Brown Abbott. And I'm joined today by Will Main, Portfolio Manager for Asian Equities. Welcome, Will.
Thank you.
We're now 12 months on from the height of the pandemic. What's driven markets over the most recent quarter?
Well, markets posted positive gains over the quarter, building on the strong gains seen in the final 3 months of 2020. And really that's been driven by ongoing record amounts of stimulus, the reopening global economy, as well as optimism around vaccine rollouts. Beyond the headline return, however, was the continuation of the rotation to value, which essentially saw cheap stocks being bid up while expensive stocks lag the overall market. Corporate actions are also on the rise. We've seen a number of portfolio companies come under takeover bid, and that's often a way to recognise or unlock value in companies that have been overlooked or unloved by the market. Sector-wise, it was the cyclicals that outperformed the defensives, consistent with the rotation. Financials and industrials, two classically cyclical sectors, were amongst the strongest performing, whilst healthcare and consumer staples were the weakest.
You've just mentioned the ongoing reflation trade and the continuation of rotation into value. How far do you expect this to continue?
So essentially, we think that the cheaper stocks are likely to continue to outperform the more growth-orientated stocks as the global economy recovers. We think it's early days in that process, and we point to a few factors that as evidence that it's likely to continue. Firstly, the valuation spreads between the growth cohort and the value cohort continue to remain elevated. It's true that they have compressed from the extreme levels seen in 2020. However, they remain well above their longer-term averages. Secondly, going forward with the global recovery, we think that there's likely to be a far more even distribution of earnings growth amongst companies. One of the defining features of the last several years has been the concentration of growth, earnings growth in just a small handful of companies. Going forward, we think that that process is going to continue to unwind as economic growth is more widely dispersed. And finally, we think that investor positioning is still very much lopsided and concentrated around growth. Our sense is that investors and asset allocators are only just beginning to revisit value strategies, and as they start to rebalance, the cycle is likely to be elongated, undoing much of the trends we've seen over the last decade.
Will, the investment team has actually been pretty busy recently. You've just come through another reporting season. Any key themes you'd like to point out?
Yeah, so certainly the earnings recovery story, apart from a couple of sectors like tourism and travel, the recovery in earnings is very much underway. Management teams across the region have cut costs aggressively in 2020, and as revenue growth returns in 2021 and beyond, we think that there's scope for margin surprise. Input costs have been rising, and it's something that we're watching. However, they remain manageable in the context of overall cost-cutting programs.
From a sector perspective, you had really strong attribution from Indian banks through the quarter. Could you elaborate on that, please?
Yes, certainly Indian banks and banks across the region were quite strong and reported good results in the most recent reporting season. And really, asset quality is proving far more resilient than the market had anticipated. With non-performing loans peaking and credit costs coming down in the coming year, we think that the scope for earnings growth looks very promising. Longer term, we think that mortgage penetration is going to continue to rise from very low levels, and growth is likely to be underpinned for that for a long time to come.
Through the quarter, we've seen a number of large economic announcements. We saw the Biden US infrastructure stimulus. We've seen rising rates and the potential for inflation to rise. What's your view on this?
Yes, certainly fiscal and monetary policy has been very aggressive over the last 12 months, and there's not a lot of evidence to suggest it's likely to end anytime soon. Indeed, central banks have told the market that they're not going to raise rates until 2023 at the earliest. Now that's feeding through into inflation expectations, and we've seen interest rates beginning to rise. US Treasury bonds had their worst quarter in over 40 years as yields almost doubled. Looking at this through a wider lens, however, yields remain very low and real yields are in fact still negative, implying that there's plenty of room for them to rise as the economy continues to normalise. Now, we aren't betting the portfolio on a materially higher inflation, but overall higher economic activity would be a tailwind for performance.
Finally, Will, just your thoughts in terms of outlook for the next couple of quarters within the region.
Yes, certainly near-term valuation multiples are no longer cheap. However, we would point to the depressed nature of earnings as they continue to recover in 2021 and beyond. And it also underscores the importance of that growth coming through for the overall market. We'd also point to the fact that our portfolios trade at deep discounts to the broader market, despite having a cyclical bias and what should be better earnings growth in the years ahead. Meanwhile, China is going to continue to grow. At the recent Economic Policy Forum meeting, the government announced targets of 6% GDP growth out to 2035, implying a doubling of incomes over the next 15 years. We think that's likely to be positive for the overall region as well as China itself. Growth is unlikely to be in a straight line, and we think that there's going to be plenty of opportunities for bottom-up investors to take advantage of.
China also recently announced that they wanted to transition to a carbon neutral economy by 2060, so interesting times ahead for that economy. Thanks for your time today, Will. Really appreciate it.
You're welcome.